fear. The stage is set, all engines go. Welcome to the angle. Let's start the show. Hold on tight, the stage is set. Dig in deep with no regrets. Red and green bars leading the way. Welcome to the angle. No time to delay. Markets rise and markets fall. Atomcash is ready to answer the call. While the bulls charge hard and the bears dig deep, the angle will keep you on your feet. Hold on tight, the stage is set. Dig in deep with no regrets. Red and green bars leading the way. Welcome to the angle, no time to delay. Cashing in on the highs and lows where the wind of fortune constantly blows. No looking back, keep your eyes on the prize. Fuel to run with a fire that never dies. Hold on tight, the stage is set. Dig in deep with no regrets. Red and green bars leading the way. Welcome to the angle, no time to delay.
Welcome everybody to the Atomcash Angle, the show that flips the switch and floods the system with straight financial voltage. I'm Adam Cash, and I'm bringing you the firepower that your financial life has been missing. And whether you are new to trading or a trading savant, I aim to turn complexity into clarity with a little shot of as possible and as quickly as possible. A few different segments today that I want to focus on. Mainly, we have a lot of data. If you caught yesterday's show, we have three big things going on today. You got jolts in consumer confidence at 10 a.m. And Lutnick, the Secretary of Commerce, at 2 p.m. We also have GDP, quarter over quarter, and ADP employment data coming tomorrow pre-market. So all things we got to talk about, but we'll get into that a little bit later. Today, for segments, we have open discussion, live trading, and market analysis, which I'm going to flip the script. Normally we do that. I'll do a little pre-market rundown, but normally we do that at open to 10 o'clock. Today we're going to shift that to do it around 10. Here's why. That jolts in consumer confidence is going to come out around 10 o'clock. That's going to jolt the market. See what I did there? Sorry, we really should have went with the more appropriate. But that data is going to affect the market very greatly at 10 a.m. So I'm not expecting anything too fantastical before the market actually, or I'm sorry, in the first 30 minutes of market open. Obviously, we'll have some movement, but I'm not expecting anything like wild. So I'd rather give commentary around that 10 o'clock time when we're getting that information. So instead, we're going to open up, like I said, we'll do first 10 minutes or so. We'll talk about pre-market stuff. We'll look at levels, see what happened overnight. Then, right at open, we're going to do what I like to call, it's a new segment, it's called The Bull and the Bear, or The Bear and the Bull. I haven't decided which way I want to go at, and why we have the picture of today's stream that you're seeing right now. Essentially, I found two stocks that are very interesting, and they're interesting for a point of view that they both have both bullish and bearish catalysts, not only from the fundamental, but also from the technical standpoint. So I'm going to present these stocks to you, and what's really cool about this segment, what I like about it, is, in my opinion, these are two stocks that have both bull things and bear things going for them, thus the name of the segment. And I'm really giving you the power to decide on what you want to do with the information, whether you feel more bullish or bearish on it, or if you're already bullish or bearish on these names, what to consider maybe if you haven't already considered. So either you take this as a trading opportunity, you can either take this as a risk management opportunity, whatever works best for you. I think this segment's going to be very valuable for a lot of you guys out there, and there are two pretty popular names in my opinion. So most of you may, or I shouldn't say most of you, some of you probably have holdings in some of these companies, so that information you might find very helpful. Like I said, then at 10 o'clock, we'll get into open discussion, live trading, some market analysis. We'll see where the market sits. We'll talk about some data, some news that's been coming out. We'll do that for about like 20, 30 minutes or so. And then we're going to round it off with options operation. If you've ever been to any of my streams before, options operation essentially is going to be a rundown of... we take questions from you guys, so if you want to, you can follow me on X, on YouTube, whatever. Drop me a DM or a comment on one of my posts, and we'll take those questions, and maybe we'll even do a live version of options operations. Not something we've done before, but maybe we could do that. But I've got two questions pulled from our community that highlight specific questions with either trading strategy or risk management strategy, and I address them live here on the air. Not only for that person to get a good answer, but also for you guys maybe to learn something from them as well. So maybe we'll throw in a live opportunity there. So if you guys want to stick around till around like 10, 20-ish, at that point in time, I'll open up the floor. We should have enough time to do another like question or two. If any of you want to throw one in there, feel free to. This should be streaming live to both YouTube, Instagram, and X. So if you're there, feel free to drop a comment in any of the feeds. I'm mainly looking at the YouTube chat, but I do have multi-stream set up, so I should be able to see your commentary as we go in general. All right, let's get right into it. We'll do a little pre-market analysis and kind of go from there. Looking right now at the SPY, currently at 548.56, kind of a nothing burger overnight. Actually, it was pretty flat until a few minutes ago. Currently down about 0.41%. Nothing too crazy. We are hovering around basically these two LOIs. And for those of you who are new, your LOIs are your levels of interest. They're areas that you want to keep an eye on your chart for significant reasons that I've deemed significant. And we have two levels that we're right in between right now. This 549.73 and this 546.87. Beneath that 546.87, you also want to keep an eye on that 50% retracement at 546.60 from the all-time high to that recent low that we saw in the market. So kind of opening in what I would say a potential chop zone with some support down here. Little iffy. Wouldn't shock me to see if we kind of just fart around there a little bit today. As is the trend from yesterday, continues today, with tech kind of leading the bearishness at this point in time. Now, I'm not being a bear, I'm just saying we're leading that way, at least at this point in time. So just be conscientious of that as we open up, obviously tech being very important for growth. So just keep an eye on that today. Also, we have Apple reporting, I believe also Microsoft. So big names reporting this week. So obviously, tech is going to be at the forefront of everyone's mind. As I said yesterday, you got over 30% of the NASDAQ and over 30% of the SPY reporting this week. You're going to see big moves. And that's why I'm very grateful there's no Fed speakers, because that's less to worry about in that time frame. And also, the trend from yesterday still continuing, with your Russell actually holding up better than the other two indexes, at least as it sits right now, with your small caps still red at the moment, but performing a little bit better than your tech, which is quite interesting. If we flip over to our sectors and take a peek at the pre-market for all of our sectors here, utilities red, technology red, basically all sectors red with the exception of materials and real estate right now at unchanged. The deepest red you're noticing right now is actually in consumer discretionary, but also tech is right there with them at 0.54. So a little bit of volatility this morning. Nothing too crazy, I would say, but enough that we're getting a little bit of a shakeup here. As it pertains to news throughout the day, like I alluded to, you have Lutnick speaking at 2. The big news around is going to be, or the big news should be around 10 o'clock. Like I said, you got JOLTS, and you also got consumer confidence. Those two things are really going to more than likely shake up the market. So you're going to want to keep an eye on that at that time, which is why we'll do live market analysis at that time. So a little bit different than we normally do. This actually just came in a few minutes ago. White House Press Secretary Leavitt says that Trump will sign an executive order on auto tariffs later today. So you're going to want to keep your auto companies on watch, or any companies that do business in that industry. Obviously, they could be affected by that. So that's something that you want to definitely keep on your radar today. Outside of that, news is looking pretty thin. I believe Trump was scheduled to speak later today at like 4:10. So I don't know if the executive order signing is going to be at the same time, but outside of your jolts and consumer confidence, not too much going on today. You do have Visa, Starbucks after hours today, so those are some bigger companies you guys may want to keep a watch on how they report. And like I said, pre-market tomorrow, you're going to want to keep an eye on ADP data and GDP quarter over quarter. Going to be some big information there. Not to mention you have the 30-year mortgage rate as well at 7 a.m. So a lot of economic information coming through the pipe on top of a big earnings week makes it for very treacherous waters. I let everyone know in our community over exclusive trading that the opportunity to trade this week is more than likely, or I'm sorry, this week, today, if you're a day trader, it's going to be somewhere around that 10:30 to 1:30, 2 o'clock time. A lot of people don't like to trade the midday. I actually like it quite a bit, but especially when we're in this area of heightened news or heightened volatility in general. Not volatility in terms of like the VIX, but I mean volatility in terms of sensitivity to the market. So if you are someone who day trades, looking midday may be your ideal point in time where you're taking a little bit less risk in terms of the bigger swings, and your IV's more than likely going to cool down. I'm expecting IV to be pretty hot from open, or not pretty hot, but stagnant. 10 o'clock, obviously you're going to get a bump, but that 10:30 to 12 after things cool off, or we get a trend. Or if we don't get a trend, I think that's where you're going to find the opportunity to find any trades, if anything at all, at least in my opinion. Let me look around real quick. We've got about 3 minutes until the open, so maybe we'll watch about like 5 minutes into the open, just kind of see how things open up here. Then we'll go into the bear and the bull. Obviously, again, two names, two companies that you guys definitely have heard of, so they're not like nobody names, but companies that you may already have holdings in. So something to obviously be mindful of. Even if you don't have holdings in these names, they offer you that bull and that bear opportunity, where I see a bull case, and I'll offer you both the bull case from a fundamental and a speculative point of view, but also offer you the bull and the bear case from a technical point of view as well. So kind of, again, the idea of it is to put the ball in your court. It's a new segment, so if you guys like it or not, I'd love to hear your feedback, and if it's something you guys like, it's just me. I will be more than happy to bring back that segment for you guys in the future. 2 minutes until open here. Not too much happening. Kind of getting a little bit of a mean reversion here on this little sell-off on the market. Obviously, that news of that executive order in regards to auto tariffs being signed may have spooked the market quite a bit here. That news came out around 9:04-ish, which was already when we're moving down here, at least on my news scanner. So looks like that added a little fuel to the fire, unfortunately, for a little bit of downside action. Considering I don't really see too much else in terms of bearish news come across the wire at this point in time. So just kind of more than likely, like I said, I'm betting on the morning kind of being a wait and see kind of thing until 10 o'clock, where those very heavy economic impact factors will be coming out. Before we get into the open here, just be mindful your VIX is sitting at about 25, VVIX back over 100. If you watch, you know what that means. And UVXY sitting at around 30. So these are levels you want to be conscientious of heading into the day. Guys, before the market opens, if you do me a quick favor, whether you're watching me on X, Instagram, or YouTube, drop a like on the stream, drop a comment, a share, whatever. Interact, subscribe, follow. Helps me out greatly. Lets me know you like the content. Lets me know you want me to do it more. As I see those numbers tick up, it helps me greatly, and I greatly appreciate it. So thank you very much for taking the time to press the one button. I know a lot of people ask for it when you watch content. I find it annoying, so I try not to ask a lot, but it does help quite a bit. Trump also, I'm reading a comment here. Trump also said that Amazon displaying, oh yeah, that's right, there was that Amazon news. Trump also said that Amazon displaying tariff impact was a hostile act. I think that's why the market dropped this morning. Yeah, you're not wrong. That was an oversight on my part. There was some news in regards to Amazon that we saw come through right before the open. Amazon showcasing tariffs on each product was hostile and political, or at least that's what Trump said. So market doesn't love that either, obviously. So I guess we will see. All right, open up right now. Like I said, kind of unchanged on the market. You're down a very little bit, 0.3%, so nothing too crazy here into the open. IWM, again, you want to watch this for sentiment, and it's leading the pack here. If we're just looking at our three indexes, SPY, the Qs, and IWM, so your Russell, your NASDAQ, and SPY, the Russell is showing good signs and has been showing good signs of a potential sentiment reversal. The key word there is potential. Potential does not mean it is. There's potential there, where in the last few weeks that really hasn't been the case so much. So it's nice to see, at least. I think at heart, most of us are bulls. Obviously, a lot of us have long equity, so we want that long equity to make money. So it's nice when we see things that give us the opportunity that things are looking good for some of our long equity holdings in general. Something else I'll mention real quick. We mentioned HIMS yesterday. Up 30% on some news here. This $35 area is going to be very important. Right now it's above it, which is great. But if it cracks under that $35 area, between 30 and 35 is kind of like a no man's land for HIMS, at least at this point in time. It needs to get a clean break above that 35. So I wouldn't chase this move, especially. But having it cool off, get in between that zone again, and if it starts to bounce, so if you see bulls step in midday, anywhere in that range, and bulls start to step in and break above that 35, that would be a good long sign, in my opinion, on HIMS. Full transparency, I sold some puts on HIMS. I currently have they were $30 puts. I got assigned on them. I own some shares at 29 something, and I more than likely will be selling covered calls later today on this move. All right, so let's get into our first segment here now that market's opened. Like I said, not expecting too much into the day here. This is going to be the bear and the bull. So like I alluded to before, and I've said probably 3 times, the whole point of this segment is to bring you guys 2 stocks that I believe have both bullish and bearish setups, both from a technical and a fundamental/speculative standpoint. And those 2 names are, well, at least I'll say the first one, Disney. DIS, stock ticker DIS. We'll look at it from a daily chart, just to give you guys an outlook here. Disney is obviously an interesting one. I'm sure a lot of you have heard of Disney, unless you've been living under a rock or don't have TV or never heard of Mickey Mouse, which I don't know. Anyway, Disney is an interesting one. So I'll lay out the bull case and the bear case from, again, more of that speculative fundamental point of view, and then we'll get into the chart to keep things pretty easy. So obviously Disney has a very strong brand. If I said the name Disney, most of you know exactly what I'm talking about, and most of you think exactly of Mickey Mouse, right? There's something associated with that, and with a lot of stocks that I invest in, especially from a bullish point of view, name and brand recognition is very important. As I said a few months ago when I was interested in taking a speculative play on Bumble, and I did, Bumble is a name that maybe not all of you know, but it does have some name recognition, and especially when names like that get into the dirt, or they're discounted, there is some value there that a lot of people discount, especially if they get really beaten down where they could be a buyout opportunity, which is not the case with Disney. But on the back of bad news, anything like that, these brands tend to be very resilient. They tend to have enough money and they tend to have enough resources to change the way people look at them if they're beaten down for, in this case for Disney, like being too woke or whatever. There is a strong brand and there's always a machine behind it, and the machine is smart enough to know how to change. So that strong brand is the very first key bullish part of Disney and why I like Disney longer term. I also like Disney due to their diverse revenue stream. So when I say Disney, you typically, or I think most people would probably think of TV, at least at this point. But you got to keep in mind, they have movies, they have streaming, and they have theme parks. So there are multiple avenues of revenue where even if certain ones are impacted, for example, like tariffs for the theme park for whatever reason, or if they're filming a movie and things cost more to get people somewhere, etc., they have other things that can balance that out. So it's not like they have sole income coming through one place. Just like you and me, if you have investments, you have other properties, you work 3 jobs, whatever it may be, you've got money coming in from different points of view, that lowers your risk. So even if you only had, let's say your goal was to make $2,000. I personally would rather make $2,000 from 4 different sources of income versus from one source of income, because I lose that one source of income, now I have $0. But if I lose one source of the 4 sources of income, I still have $1,500. It's easier to recover, it's easier to take the blows, but it doesn't really diminish the opportunity. In fact, the opportunity is even greater because you have your tentacles in more things. The only way that's a downside is in the event that you over diversify. So in this case, Disney goes too far out and you spread yourself too thin, costs too much to maintain. So there is a bear part of that as well. But for me, at least, especially in this climate, I believe the diverse revenue stream that Disney offers its investors is actually very intriguing, especially in this climate where it can make with what it's priced at today, a more valid price to take an opportunity here on Disney in general. Going off the back of those revenue streams we were just talking about, specifically looking at Disney Plus, they've had growth in subscribers, which is pretty good. Very competitive landscape with streaming, obviously, but seeing growth in subscribers is a great sign. Subscription businesses in general tend to do very well, especially low cost subscription business. Obviously, they have bandwidth, but and the cost of creating these shows. But if they're streaming other things that have already been created, or things are just evergreen in the sense of people want to watch Star Wars, and why would I go out and buy Star Wars on Blu-ray for, $10 or whatever it is, $100 for all the episodes or whatever, when I can just buy Disney Plus for $9.99 or whatever it is and just watch it, stream it right now on my couch. There is evergreen content like that offers them the opportunity to have growth. And let's be honest, if you have a subscription that's cheap enough, so there is a realm of bullishness there where they could just have this constant rolling ball of making money. And that's how Netflix has been so successful as well. You just have the opportunity to continue to make more and more money. The only way you fall into a trap there is if you are increasing your cost of producing said content. So there's a little bear case there. The other thing you want to keep an eye on is how, and again, 2 more bullish points. They've had recent cost synergies from acquisitions that help support their growth. So the acquisitions they've been doing in general to help support them longer term, while short term can be seen as a negative due to obviously the cost of acquiring anything, longer term it supports their growth trajectory down the road in general. So that's something that I like at this point. Again, this is not for a day trading perspective. It's more from a longer term perspective here. And again, lastly, beating earnings pretty recently. I mean, the earnings have been pretty good the last 4 quarters, not awful. The last one in particular was pretty solid. So with that being said, you do have earnings coming up here on the 7th. So next week after. So be mindful of that. That obviously can change things here. Now, that being said, we've highlighted the bull factors, why you should be or consider being a bull on Disney. Well, now let's look at things from the bear side of things. And again, if you're long on Disney already, you can at least take the information here and say like, well, I'm already long. Maybe I understand the bear case so I can limit my risk. Or if you're already a bear, you could say, well, I want to understand the bull case to limit my risk the same way. So it's not only that you should be looking either side of the coin to open a position, but if you're already involved in a position, you can mitigate your risk that way as well by understanding it. So with that being said, looking at the bear side of things, they have a pretty high debt level from the acquisitions, like I just alluded to, where longer term, I deem that as a bull catalyst. Short term, that could be a bear catalyst, especially if things get more expensive. With the economy in general and tariffs, things could get more expensive for Disney. Those higher expenses could obviously impact their bottom line, make it harder for them to produce more things to make more money. Could make their financial situation get a little tighter. Definitely a concern. It goes without saying, and I alluded to it already, competition from streaming and Netflix and everyone else. What do you got? Paramount, Peacock, Netflix, YouTube TV, Sling. There's a ton of streaming platforms. HBO Max or Max now. There's a ton of streaming opportunities out there. There's a big market. There's also a lot of options. And I think more than likely, and if you guys are listening right now, just out of curiosity, if you could drop a 1 in the chat wherever you're watching, if you have more than 1 streaming subscription, just put a 1. If you don't, put a 2. Just out of curiosity, I just want to get a quick little feel on if you guys have more than 1 streaming subscription, drop a 1. If you don't, drop a 2. Reason being, this could be a bear sign of things because obviously people want to keep their expenses lower, right? They don't want to have 50 subscriptions. But at the same time, subscriptions aren't too expensive where it's really harming their bottom line. I like it as well. I deem it less risky as well, mainly due to the fact that it's Disney. So the content on Disney is kind of family oriented. So if I had a family and I had to cut a subscription, maybe I keep Disney because it's for my kids and me, right? So there may be some opportunity there where it's not necessarily a bear sign of things necessarily, but obviously that streaming competition is something to be considered of. Okay, so we got a 1 and a 2. So some little split. So that's okay. I was just really wondering if that was common or not. I personally have more than one subscription, but that's just me. Um, Obviously, another bear sign of things, economic sensitivity due to tariffs can cause a slowdown potentially in the theme park. So outside of things costing more, right? Outside of it maybe costing more to bring in the things to make the stuffed bears that they sell at the, or import the bears that they sell at the amusement park or whatever, right? But the fact that people are paying more across the board means that people have tighter wallets, tighter purse strings, right? If people don't have as much expendable income, maybe they're less likely to spend money on things such as going to an amusement park, which is or have you seen the prices of going to Disney right now? The Good for them that the people can still go. It is dumb. It's expensive. Going to an amusement park in general is not like cheap. And people know, especially if you're at Disney, like people dream of going to Disney World or Disneyland, right? So I think people are willing to, for lack of a better word, go into debt to go to Disney. But I think that makes it a much harder pill to swallow with people having less money to spend than they normally, or they already do, right? The dollar doesn't even go as far as it used to go. So now you may still want to go in debt to go to Disneyland or Disney World or whatever because you really want to, and that's like your life goal. But now that debt, instead of it being like you're in debt like $1,000 or whatever, now you're in debt 4,000, right? Or whatever it may be. So that pricing sensitivity could scare off a lot of consumers from actually going to the theme park in person. They can combat this by keeping prices the same and eating a little bit of a loss in the profitability. So theoretically keeping foot traffic the same, but that would still impact their bottom line because now, even though foot traffic theoretically is the same, if things cost more and they're not raising the price onto the consumer, obviously they make less money. So there is two schools of thought there and how that really could work. But definitely a risk factor, obviously. And lastly, labor disputes could pose risks. Minor threat, in my opinion, but something to at least consider. So we've highlighted what to look for from the bull side of things, what to look for the bear side of things. Let's look at the chart. So currently Disney is up today, creating around 90.50. And I have an LOI here from a while ago. So it's old support at this 89.31 level. So we're just above that right now, which is a good sign if you're more on the bull side of things. I line this out. Here, we'll zoom out a little bit. So this green line on my chart is where I'm more bullish. The bull case is taken off. I like the bull side of the trade. The red line here is my bear side of the trade. This is where I'm more bearish. This is where I see the opportunity to short. So we're waiting, as I like to tell the people in our community exclusive trading, I would rather show up to the right house. So if there's a house party, right, I'd rather show up to the right house late than the wrong house completely. Right? You want to be at the right party. You want to be a bull or a bear at the right time, rather than be completely wrong and down the street at the wrong house, right? At some dude's house who's got a shotgun when you open the door. You don't want that. So the way that we laid this out, and again, from more of a long-term point of view, is to give you those pricing opportunities both ways. So you do have a bit of what I'm considering more of like a chop zone. And again, we're looking longer term. So we're talking weeks, months down the line here. This 108.46 is an important level. This 89.31 is an important level. In between there, you're more than likely going to see some level of chop, mean reversion, price discovery, distribution. It's going to more than likely fart around in here. Here, let's look. This is the weekly chart. So we go all the way back just so you can understand the importance of these levels. This range as a whole, so obviously you have some points that bump above and bump below, but this range as a whole has held since almost 3 years. Actually, 3 years. This range has held. And I want you to look here also at our green line. So I'm calling the green line the go line, and the red line is the go to hell line. Which is basically kind of like the extended range of this little chop range here. Kept it super simple for you guys. Which is right up here, 118.02. So breaking that and getting sustained movement over that with volume is more bullish. And breaking under this localized low here, so this 3-year low at 77.77 pushes you to the downside. That's on your weekly chart. Both of those breaks are not going to be easy because Disney's comfortable in this range. But if you do get a bigger range break here to the upside or the downside, you should get a continuation. And that's where we highlight these other levels that I have on the chart here. So as a bull, a longer term bull, if and when you do break that 118.02, these are the three price targets I'd be looking at: 145.45, 165.06, and finally 185.29, which puts you below the all-time high. Obviously, you can include the all-time high as a target as well. But those are the three price targets I'd look at the upside. So that offers you about a 100% return on equity here, a little bit more, if you were to get in like literally today as a bull. But keep in mind, like I said, we're not past the go line. Now, if we go to the go to hell line at 77.77, you have two price targets here, and then this final level in which I would close out and actually flip an aggressive long. So that's why that last level there is red. So breaking that 77.77, you've got about a 50%-ish drawdown. So the risk to reward, theoretically, if you're opening somewhere in this range, it's about 50-50, which kind of makes sense because you've been range bound anyway. You kind of have 50-50 risk to return here. Where if you break here, two price levels I'd be looking at prior to the final one being tapped: 62.93, 46.49, and lastly 32.91. So it's your bear side of the trade. Now, if we get back here to 32.91 under any reason, then that is where I'd close the short completely and open a long, a big long. Because like I said, for me personally, companies like this that have strong brand identity, even if they get beaten to the dirt, even if they have horrible financial issues, whatever, I will take a stab on that kind of company because I don't think anyone would let it go anywhere. Too big to fail, so to speak, right? At that point in time, you're currently trading at a $163 billion market cap, getting about a, what is that, $60 haircut. Still drops you. You're still a big company at that point. That's still like a $60-ish billion company. So it's still a fairly large company even at that point in time. And getting to this top line up here, I mean, you're still within a reasonable valuation, reasonable being in the past, but you're all the way up at like $300+ billion. So that's your risk to return here on Disney as a whole, about a 1-to-1. But again, you want to wait, at least in my opinion, till you either break the go line or the go to hell line. So now that you guys have all the information you have the bull side case, you have the bear side case, you have the bull lines and the bear lines, you can do what's right for you, whether you're already long, already short, whatever it may be. I hope this information will help you at least make educated trading decisions on your trading journey. Now, like I promised you, I did have another name for you, which is right on time. Good morning, Beastwood. Hey, Neff, thanks for showing up, brother. I have another name for you guys I want to share, and that name is Snapchat. Again, another name most of you probably know. Snapchat's an interesting one. I have feelings about this company, but I'll stay neutral. Whether bull or bear, I will stay neutral. I will give you, again, the bear and the bull, the good and the bad. You're getting it right now. So, Snapchat currently has good growth in their, so we're going bull case first, I'll make that clear. Currently has good growth in their user base, up about 10% year over year as of Q4 in 2024, which is a good sign that people somehow are still using Snapchat. I'll be honest, I have Snapchat on my phone to snap my wife pictures of her dog, and that's about it. I could text her the same thing, but for some reason we use Snapchat. So I guess I'm still using Snapchat, but outside of that, not a platform I personally use too frequently. But hey, they're growing their user base, so they're doing something right. The other thing you want to be... I see this as a bullish thing. I don't see it as a bear thing by any means, but it's curious on where this could go from a technology point of view. Is how they're innovating with augmented reality. Obviously, they have a lot of face data, right? People take selfies, and you can put like the stupid glasses on your face or the dog nose or whatever, right? In my opinion, they would be foolish not to take that information and do something with it. And they've been really leading augmented reality when you think about it for quite some time now. And they even have some augmented reality like brand deals where you can take a photo and like a Cheez-It pops up or something stupid, right? But they have something there with augmented reality, which I find very interesting. That is what I think is actually the most bullish thing, but it's also the most speculative. They definitely have a lot of information there. Whether or not it's something they can turn into profit is yet to be seen, or turn them into a buyout candidate maybe down the line if evaluation gets cheap enough. But that innovation in augmented reality, kind of being a first mover there, I think they know quite a bit about augmented reality as a whole, and I think that's something to be cognizant of. So I would mark that down as a bull catalyst. Definitely not a bear catalyst. The only way to be a bear catalyst is if they're sinking ton of money into augmented reality, but that doesn't seem to be the case, with the exception of their Snap glasses thing. Advertising revenue, there's a lot of potential there, so I mark this as also a bull catalyst. There's a lot of potential brand deals, like I just said, with like photos and stuff like that, and they actually have a decent like a discover page. I don't think they market it well on their app at all. Before today's show, I went on Snapchat and I just kind of looked around. You can kind of scroll to the right or whatever, and they have like different little mini shows, kind of like shorts or reels on Instagram, which it's not bad. The content on there is actually not bad. It's just displayed, in my opinion, in a confusing, horrible way. So if they could take the content and make it easier to access, I think they could have some opportunity there. And obviously, having more viewers, which growth in the user base has gone up, so it's good. They can make more money, obviously, through advertising. So there's definitely potential there. In general, I think as time goes on in that same realm, or so in the same vein, they will develop stronger partnerships with these brands where if I have a company and I advertise on Snapchat and I see success, I'm going to want to do more things with Snapchat, which can get, again, back into like the augmented reality thing where I would do a unique advertising campaign that only works on Snapchat. Like, again, with augmented reality, a Cheez-It coming out of the floor, right? There's that opportunity there where you could have very unique ways to advertise that really only Snapchat can do. Obviously, there's Meta with Instagram, TikTok, very similar things, but I think Snap could have an opportunity to present that information in a unique way. And lastly, recent earnings in general show that ad revenue is actually going up by the tune of roughly around 20%. So growth in the user base going up and ad revenue going up kind of go hand in hand, but it is a sign that they're making money or still competitive in the landscape in general with other social media outlets. Now, for the bear side of things, I think that's a good segue. Obvious competition from Meta with Instagram and I guess Facebook, but really more so Instagram, especially with Reels and Stories and TikTok. TikTok's huge. Instagram's huge. I think what Snapchat would need to, in order to be successful, is carve out more of a niche, and I think they could do that through the content they have on there if they can produce it and display it in a certain way. On top of that, their average I'm trying to figure out how to. I try to say things not in a way where I'm influencing things. I try to keep opinion kind of neutral here. So I'll say it like this. I think they would have monetization challenges, meaning they have content, they have advertisers. Advertisers are spending more money. That's good. I don't think they're fully taking advantage of it. Snapchat Plus, for example, is stupid. I mean, I already don't use Snapchat. Maybe if you use Snapchat a lot, you find it useful. But even paying $1.99 to get like a puppy filter or whatever dumb thing seems really dumb to me. I would love to be proven wrong. But I also don't know where else you monetize Snapchat. I really don't. For example, X had a really good job, or Twitter, with putting up the premium plus, right? You get a blue check mark next to your name. You see less ads. You get promoted in the algorithm, whatever. For certain people like myself, who's a creator, that can be kind of useful. Hey, it's not the worst thing ever. It's $8. Great. But on the flip side of things, like comparing that to Snapchat, even if it's just $2, it's just $2 I don't need to spend, and I don't think I'm getting any value. And I think where Snapchat could find the opportunity is finding what that value is to present that value to the consumer. And I don't know what that value may be, unfortunately. PS ratio in general is a bit high on this name. So if you're comparing this to your peers, so like, again, like Facebook, I mean, if you want to throw it in with Google, any other like social media related company, it could be even considered at a high valuation, even at these levels. You're really buying a half growth story stock here. And that's if you believe in the growth trajectory. So very bearish depending on your personal opinion. And last thing, Tariffs, obviously, that could impact how much money companies make. Companies make less money, they have less money to advertise. If they have less money to advertise, they either do one of two things: cut out advertising completely, or they really tighten the belt and be very selective on who they're advertising to. Now, you could argue that could be a bull catalyst if Snapchat had a unique way to present information to the public. I just feel they don't, at least in terms of advertising. So as a result, unless they see a lot of success on Snapchat, that's going to be one of the first things they cut. Now, my background's in marketing, and I understand when times get tough, if you're working in the marketing side of things, you're the first to go. You are non-essential. You are important for growth. You're important for getting the name out there, right? But the actual day-to-day business, unless like your business is pure growth and pure like we need to get more customers right now, advertising is extremely important. If you're an established company and the established companies are the ones that have the money, they may not even advertise. For example, Procter & Gamble, maybe they just stop advertising completely. You're still going to buy your Head & Shoulder shampoo. You still know it's a brand, right? Things don't change. Tylenol, right? I'm just naming names, right? Tylenol doesn't need to advertise anymore. You'll still see an ad on TV, but if they really wanted to tighten the bootstraps, they could just stop advertising, and you're still going to buy Tylenol if you buy Tylenol already. Like, you're not really informing anyone new, right? So those mature companies, like I said, those are ones that already have the money. They may not spend any more money because they have it already, so they don't need to. Like, they don't need more market saturation because it's not really there for them to even take. It's a low return. So if tariffs are that strong of an impact, that could be a major bear catalyst for Snapchat. Now, with that being said, let's zoom out and let's look at the bull and the bear side of things. I don't think I marked this out. This is supposed to be green. There we go. Green. All right. Right now, Snapchat's sitting around 895. Stream is really spotty. Don't know if it's me or not. Yeah, I'm sorry about that, guys. I fixed a few settings, so I'm trying something new today. And I appreciate all 142 of you watching live. Thank you very much. Before I get into this, do me a quick favor. Drop a like on the stream, follow, comment, etc. Really appreciate it. Thank you very much. But I did change a few settings, so hopefully this is a little bit better. I'm going to watch it back and see what else I can change. So apologies if things cut out. Still work in progress. We'll get better as time goes on. With that being said, here's Snapchat. Currently trading, we'll call it $9 for simplicity. And, well, it's interesting to say the least. Your bear line here is this 708. So your go to hell line is 708. Breaking that, and I think you're not going to get too much. I mean, it doesn't look like a lot, but it is about like a 40% discount, really. Breaking under that 7 gets you to, maybe not 40%, but breaking under that 7 gets you around this 482. And that's where I'd be interested in closing out a bear opportunity, mainly because you're risking at that point the all-time low. Now, maybe I wouldn't be super aggressive on closing that short. I'd want to see if the all-time low breaks, because things can also always get worse. But that would be the area in which I'd start to consider closing out a bear side trade, depending on volume and other factors at that point in time. Also, crazy giant Head and Shoulders on the monthly chart. Anyway, but that 482, that all-time low, is where I'd look for either to take some profit off the table as a bear, or just rethink the strategy there, see what's going on. Decent markdown, though, if you break the 708. Now, that being said, if we zoom back in a little bit, here, we'll go to the weekly. Actually, let's zoom out a little bit more. Let's go to here. Kind of a similar story to Disney. Kind of broke into this range back in 2022, mid-2022, about 3 years ago, and kind of held this range. A little bit rangier than Disney, all things considered. But nevertheless, still stuck in a range. With that being said, this $11, basically $11 even. There's a few pennies beneath that, but I marked it out as 11 for simplicity's sake. $11 is a big flux point. You could use it as a strong line in the sand where I am not a bull or a bear, but that is a point where I don't really want involvement either which way. It's very iffy. Breaking over that and getting some legs over 1305 is our goal line. That pushes us bullish. Breaking over 1305, you've got 1484 and then 1723 as my two take profits there, which nets you about 100% return, assuming you were to get in like today. So you've got a little bit more opportunity to the bull side. If the bull side ends up playing out, you do have to wait a little bit longer unless you take an earlier, riskier stab down here around 11. With that being said, there is a lot more bull opportunity, in my opinion, if it can get some legs above this range. But I don't want to lie to you guys and say something that would be far-fetched unless they say something fantastical during their earnings, which I believe is actually tonight. It's very soon. Tonight. So unless something fantastical happens, that obviously can change everything. But as things sit right now, I think a very realistic bull target, top of the bull target, would be 723. Obviously, you can move stop ups, let winners run, etc. But that would be what I'd be looking for. Anyway, guys, that was the bear and the bull. Hopefully you liked it. If you could drop a comment, let me know what you think. If you like that segment, you don't. If you'd like to see something different in the future, let me know. It'd be very helpful. And if you want me to keep the segment around. So if you like that, I'll put it down there and we'll keep it around in the future for future shows. Now, it is 10 o'clock, actually. We're right on time. Jolts and consumer confidence just rolled out. Let's see what we got. Okay. All right, so we got a lot of news, actually. While I was talking, China apparently at 9:50 to waive tariffs on U.S. ethane products. So they waived a 125% tariff on ethane imports imposed earlier this month. Great. So natural gas has a tariff lifted from China. Good for them. Good for us. All right, consumer confidence coming on at 86. Forecasted was 88, so kind of moot. And Jolts came in at 7.19. Forecasted was 7.5, so a little low. Consumer confidence report. Average 12-month inflation expectations reached 7% in April, the highest since November 2022 when the U.S. was experiencing extremely high inflation. Interesting. Those are just like some of the highlights from those two reports right here. As of right now, market reacting with some price action here, obviously, but holding on to the highs of the day, which we'd like to see. Ironically, the script has flipped here. Qs are showing strength and IWM is actually showing weakness, which makes sense, especially when you're talking about consumer confidence. Again, you want to use IWM, especially in this environment, more so as your sentiment reader, right? How people may or may not feel. So the fact that it's sitting here on that data isn't shocking, but it looks like tech is going to try to take the ball and hold things together here. May look for an opportunity. I want to wait a few more minutes here. It's an interesting point where I could see it going either way, at least from an intraday standpoint. I said this to our members over Exclusive Trading this morning. At 5 in the morning, your best time to trade if you're a day trader more than likely is going to be between 10:30 and 1 o'clock, that midday time. I know it sounds funny because a lot of you may not trade midday because volume's low, etc. But we just had news come out, so we're going to have some volume. IV is going to pump up, so as IV comes down, gives us an opportunity to look at the market and a little bit of calmness before Lutnick speaks at 2, which is going to cause more than likely some volatility. Trump is going to say something at some point today. We already know this. Not that that would be a surprise, but he's going to announce some sort of auto tariff, which means he's also just going to open his mouth in general, which regardless if you like him or you hate him, he's going to say something and the market's going to do something. So that's a risk factor. So I believe the opportunity to trade today, if you are a day trader or an intraday trader, is going to be more than likely somewhere between nowish and like 1 o'clock. I also like to say, don't always look for an opportunity every single day. Some days you may make 10 trades, right? You may trade a lot. Other days you may make 0. That's okay. A lot of people on social media will focus on I need to make X dollars every single day. I need to make X percent every single day. The opportunity the market gives us is not consistent. And this is where we go against human nature. Human nature tells us if for example, like weight loss, right? If I cut out 500 calories every single day, if I'm in a 500 calorie deficit, I will lose 1 pound of fat a week, every week, because 3,500 calories is equivalent to 1 pound, right? Using that as an example, you're logically thinking in your brain, that's easy. I will just eat 500 less calories than I normally do, and I get said result. The market does not work like that. If you have a trade system that works, you are not going to pull out the exact dollar amount every single time, nor will your losses be the same every single time. So the opportunity shifts every day, and it's important to understand the opportunity shifting, where some days you may have a ton of opportunity and other days you may not have so much. And when I say opportunity, I'm not just saying bullish, I'm saying bearish too. There are times where being a bear makes a lot of sense and being bull makes a lot of sense. It's not one and one. It's not always the same thing. And maturity as a trader is understanding that you don't always have to hit the gas every single day. That some days are days you floor it, and other days you just sit and wait in your car and you don't even turn it on. And today and tomorrow, that's why tomorrow's stream's called May Mayhem. Which, if you don't know, I'll be streaming again tomorrow at 9:15 right here on X, YouTube, and Instagram at 9:15 a.m. Eastern. That's why tomorrow's stream's called May Mayhem. You have the end of a monthly candle, which if you look at this monthly candle right now, and I'm sure if you're on social media, you see people talking about it, we could have a pretty crazy candle. That could literally change between now and the end of day tomorrow. This could be a nice little liquidity sweep, crazy hammer candle on high volume with a crazy wick. I'm sure a lot of people would love that. I know I wouldn't be too mad at that either. So these are things to consider in your trading. And we are right around that Liberation Day pricing as well, which is an important area. That gap still has not filled. That gap fills at 554.81, which I don't believe it filled, right? Oh, no, I lied. 554. No, I did not lie. That gap still has not filled. So 554.81 is going to be a very key level to watch if we do get there today. To let that gap fill to the upside, and you may see bears step in at that point as well. So regardless of what the news is, you may see some people taking a bear stab there off of that gap fill. So be very conscientious of that today as well. In general, I said it yesterday, and I was the only one who took a bear side trade, but I don't hate a bear trade today. I think what I want to see if I take a bear side today is if we tap that gap fill. Because in general, I'm not expecting fantastical moves without a news catalyst. So the fact, I mean, yes, we had news in this case. But it could just be an opportunity to sweep liquidity to the upside, which is something that I'm looking at right now. UVXY is at 29.50. VIX is down, which is good. We like to see that. I mentioned this, I believe it was on yesterday's stream. This 2309 is what I'm looking to interact with on the VIX before volatility gets a potential bounce. Potential, when I say potential, I mean like of any significance. That's the area I'm looking for the VIX to interact with. Your VVIX is still over 100 though, which tells me there's a decent chance of volatility whipping back to the upside today. Because your VVIC is only down 0.24, so the volatility of volatility is actually holding pretty high. Yeah, so that'll be the trade today. I call it today a fishing day. When I say it's a fishing day, think of it like you cast your line out and you wait. And that's what I'm going to wait for today. I think the short opportunity on the gap fill from the Liberation Day would be the opportunity I would take, if any at all today, or even... excuse me. Even around this 553 area, which I've already missed because I would have already opened that short. I was thinking between 553 and the gap fill, which is at 554.51. But we will wait and see. There could be an opportunity there. Now would be a good time, guys. If you have any stocks you want me to take a peek at. If you have any stocks you want me to take a peek at, feel free to drop them in the comments on the stream, whether you're on X, YouTube, or Instagram. I will take a peek. I'll pull up the stream right now. So if there's any names you guys want me to take a look at, let me know. I will take a look for you. And we'll run through some live analysis. So just going to hang out here for a few minutes. Probably like 6-7 minutes or so, unless you guys drop a few names, and I'll fire through them all. And then we'll do, like I said, some options operation, which is one of my favorite things. I have two inquiries from traders, one regarding Apple, one regarding NVIDIA. So if you like that, make sure you stay tuned. And then also I'll open up to you guys. If you have any questions about specific trades without asking for direct financial advice, I can tell you how you can look at the trade differently, especially if it's one, that's why it's called options operation. If you're in a bad options play, how can you kind of get out of it? So that's something that we like to do on options operation, if that is something that interests you. SPY right now at 552. It's very iffy. I'm happy I flipped the script on what I was going to do for today's stream and talked about Disney and Snapchat first prior to prior to this little bump. Snap moved up to 9. Disney got a little bump to it, 90.88. Not too bad. Not too bad at all. So what I'd want to see here is a bounce literally like right around here and go for the push to get that gap fill. That's where I'd want to take that short. Your 5 minutes still pretty good. It could, if I did take that short, I'd be looking for right around here, this 551.16 to interact. But like I said, I missed the boat on that. I was waiting for either 553 or the gap fill. So I did not get what I was looking for there to open that short. Really interesting here. So here's a great example of how these LOIs that I have work in real time. So this 549.73 has been here a while. Today, first 5 minute candle interacted, act as resistance. Second 5 minute candle act as resistance. Third 5 minute candle broke through in a big break on decent volume, higher volume than the prior candle. Moved up, came back down. Then look at this 5 minute candle right here, 10:05. Back tested the LOI, moved right back up. Actually, that was only off by 4 cents on that back test. So pretty solid. So when I give you guys these levels to look at, even if you don't like what I do or whatever, maybe at least consider it in your trading because they tend to hold some level of significance. Okay, it's looking like we're going to backtest POC here. POC is right here on your volume profile. So actually, let's get the whole day there. There you go. That number currently is 551.03. So we'll see if that gets tapped or not here momentarily. Okay, what else we got going on here? Huh. Thanks for sharing that with me, Toby. Only accounts I follow can chat. Oh, I'm sorry, guys on X. Apparently, you can only chat to me if I follow you. That's interesting. My apologies. I'll have that fixed next time. It was supposed to be that you would have to follow me to chat. Just like you have to subscribe to me on YouTube if you wanted to chat. So, my apologies. That'll be fixed next time. Alright. Looking like we're going to get that POC tap. Would have been a great short. Shoulda, woulda, coulda. It's okay. We'll get the next one. Look at the Qs right now. Yeah, Qs are faring more resilient. IWM's actually near the low a day here. So not a great sign for sentiment in general. VVIX back up again. UVXY bouncing a little bit. Where's my VIX? VIX 25. So volatility a little whippy here, which makes sense. We just came back down. I would love to see, so even if we don't tap the POC, like I said, a big push up, get that gap fill, and that's where I want to take the opportunity on a short. If I do take a short, so that would be up at 554. Let's keep a watch on the... I'll keep a watch on the 554s and the 552 puts for today. If we tap that gap fill level, that's where I'm going to look. And depending on the time of day, that's where I'd find the opportunity. And depending on other factors, so like how we're looking. If I want to take a little bit more risk, I'll go a little bit more at the money at the 552. If I want to de-risk, because again, you're looking at a 0 day in this case. So time is very important. De-risking and go closer or even at the money. And you can still make a fantastic trade. So it's something to be mindful of if you like that idea. Couple for me, please. Microsoft and Amazon. Sure thing, man. Microsoft. Boop, and Amazon. Amazon had that news this morning, so that could be a little jaded. Let's see. 4:30, 5:1. So Microsoft has earnings tomorrow, and Amazon has earnings Thursday. So take everything what I'm going to say with a grain of salt, because obviously earnings can bully any name around quite a bit. Microsoft. So here's what I'll say about Microsoft. Microsoft looks like a more bullish NVIDIA. Because NVIDIA looks more like SPY. Microsoft's actually holding up better, in my opinion, than NVIDIA or the SPY. What is the high of this? 396.36. That's the level to watch. That one's simple. That's the high of this 325 candle. And then look at this for support here, 391 even. That's your POC. Real simple here. Even intraday, this range is valid. Breaking over that, you could get a quick little markup to this 406 area. Depending on your time frame, that would change how I would view this. It is definitely trying for a bull reversal here. I mean, really fantastic move over the last week or so. Big move. Earnings are obviously going to affect that. Earnings are going to be big. Okay, so if you guys don't know what the SAR indicator is, it is one of my favorite indicators. Basically, it's an indicator that stands for stop and reverse. It's these little dots you see on my chart. So these little red dots and these green dots. It's one of my favorite indicators, and basically is structured off the thought that the market moves in a parabolic nature, so to speak. And while breaking a SAR indicator, so they're called bubbles, breaking a bubble doesn't necessarily mean it's bullish or bearish. With that in place with other technicals, it can be pretty nice. So this is the weekly chart on Microsoft, and currently has a red SAR bubble. If we zoom in here nice and close. Actually, we just popped it literally right now. Literally as I'm talking. We had a red SAR bubble there. So typically when you see the red bubbles come down, that's indicative of a bear trend. And when those bubbles start to flatten out, like you're seeing the last 2 weeks here, once a candle breaks it, it tends to at least indicate, depending on other factors as well, that in this case a reversal could come. Consequently, as you can see back here, when the green bubble popped, even though it marked up a bit first, but it stayed within its range here, that was indicative of a bear trend. So popping that bubble literally right now is something you want to keep an eye on. Also, I like the fact on the weekly that you have your MACD curling up here as well. So your MACD curling up, popping that red SAR bubble on the weekly, pretty nice. You popped it on the daily today too. So you have two things working for it. If this earnings is good, it's going to clear this 406 in my opinion. Not like I would say that I would buy calls on the earnings necessarily, but cracking, those are two things working in its favor. You already have a bullish, so more shorter term MACD, which is good to see because I could lean to longer term flips. You're above all your EMAs and MAs with the exception of the 200. Would not shock me if earnings are good. If earnings are good. If earnings are good. That's the key point. I'll say it one more time. If earnings are good, you clear this 406 with ease. With ease. And if that 406 gets some legs, you're going to get a pit stop here at the 200 at 413.56. But over that, you've got this big old gap in play. All the way to 439.11. I would definitely be a bull before being a bear on Microsoft. Now, with that being said, they have earnings tonight. Or tomorrow, sorry. That's a big factor. Actually, I believe one of our questions... No, it wasn't. There's other ways you could structure a trade through earnings, like a calendar spread that you might like, which I might do now that you've said this. I like a calendar spread here. But I prefer the bull side of this trade over the bear side of this trade. I think the bull side of this trade is very attractive. Please don't be dumb and take what I'm saying as a sign to YOLO all your money into options expiring this week that are way out the money. That is not a smart thing to do. But maybe either doing some sort of spread, either a calendar or a call debit spread or a put credit spread, some sort of spread where you reduce your exposure you could do, or buy shares. Or this one's a mind melter. Be ready, guys. This is the high tech kind of things that only expert investors will. They actually don't even tell you this. This is like top secret stuff. You can do nothing. You don't need to trade. You can wait till after the earnings, then make a decision. How many times have you seen an earnings go through and the stock goes like, whoop, 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 and then just next day it's like flat, like nothing? Could happen. And as an options trader, you want to be mindful of that. Now, if you could sell some options also, you could do that. You could do some sort of credit spread where you could take advantage of that as well. Something to consider. So there are options here, but I would definitely be a bull before being a bear on Microsoft. From a technical perspective. Let me say that again. From a technical perspective. Amazon Look, Amazon's not going anywhere. I don't hate it. If this basically right where it's at its weekly POC. So literally right here, 186.46 is his weekly POC. Going all the way back to, well, including like the last year of price action. So it's a pretty important price, literally right here. I don't hate it. I dislike it more than Microsoft only because of how tariffs more than likely will impact Amazon specifically. Counter trade to Amazon would be something like an Etsy that I am bullish on right now. Because Amazon's a lot of drop shipped crap, to be honest. And it's hard. It's hard. I don't think they're going anywhere. Their AWS business is obviously huge. I think they're doing a lot in the background and other underutilized markets right now, especially with like AI and stuff. So I do think there's a lot of opportunity there. You have Prime Video, right? There's other, it's not just Amazon.com, the website that sells you things. They have other tentacles, just like Disney, right? Which I like. This name in particular, I actually would definitely wait for after earnings. I think if earnings are good, it could get a decent pop, mainly because there's been a lot of, I don't want to say bad news, but a lot of spook. It's a lot of scaredy cats around this name right now. I don't really know what to call it. If you're a long-term investor, picking up some shares here, it makes sense. I wouldn't put my full position on it, meaning let's pretend you had $100 or $1,000. A tenth, it doesn't matter. Use a whole number, $100. Maybe you go half size here, $50, right? And then maybe you save 25% in case it gets marked down to the 200 MA, which lines up pretty closely with the low of this August 2024 candle, which was the last bear market. So maybe you save that 25% there, and then as it recovers, you can input the other 25%. Not a bad idea. I wouldn't short it either, to be fair. The monthly is looking sour, though. This candle is... This is an important candle close for them, too. It's kind of a weird-looking candle, to be honest with you. Where this price closes, which is funny because it is on the end of the month, right? Or is that on May 1st? Is May 1st? Never mind, it's on May 1st. So, it's a weird one. I, as a long-term investor, would treat this differently as a trader. Here, look at this from the monthly point of view. If you were to take a black box and put it over 1, 2, 3, 4, 5, the last 5 months of price action, you're buying at all-time highs. So as an investor, right, again, we're taking trading out of the equation. We're looking at things as an investor. Do I want to buy... What makes Amazon more bullish right now, long-term, that I'm willing to buy it at old all-time highs to appreciate even more money, right? To make more right now. What has changed? So if we remove the last 4 or 5 months, right? We take that out of the equation. What has changed from this period of time, or even this period of time, to make me more bullish? That would be a question I would ask myself. And again, it's not that I'm a bear, but I like to look at things not to be bear or bullish necessarily, but from a risk to reward standpoint. What is my risk here and what's my reward? And is that in my favor? In my opinion, Amazon's not going anywhere. If you have a long time frame, you'll probably be fine regardless. It'll probably double in price between now and 20 years from now, right? Duh. But you have to include the opportunity cost, right? That money could go somewhere else to another trade that could make you more money instead of parking it here, which isn't wrong, right? But also, what's my reward here? We don't know the reward. I mean, all-time high is only $60 off of this level, and it's been marked up pretty good. Is there a better buying opportunity if it draws back? More than likely. Am I willing to wait, or am I that aggressive that I love Amazon that much and I'm that confident I want to get in right now? These are the kind of questions you want to ask, right? So for this name in particular, especially because of how the chart is, especially the news surrounding not only Amazon, but the world economy in general, and specifically with China, because that's going to affect Amazon, I would just wait till after earnings. I wouldn't touch it. I think if you do love it long term, breaking that up, that would be the way I would go. If you had 100% of your money and you really like it, 50% right here on the weekly POC would make sense. Right there. Which again, that weekly POC is 186.64. You're right there essentially. Saving that other 50%. So again, if you had $1,000, you put $500 on the line right now, you take the other $500, you just put it aside. You don't spend it on another stock. It's set aside intentionally for this purpose. If and when it taps a 200 MA, or maybe the low of this candle here back on the 9th of August of 2024, then you take 25% of that, put it back in. So now you buy $250. That's going to lower your cost basis, give you a better average, and you're not rushing in. You didn't go full size at this questionable level. Then, as and if it recovers, you can take your last 25% and buy in a little bit more, or, God forbid it fails, you have that last 25% again to lower your cost basis. So you're kind of like doing a dollar cost average, but at very strategic points in time. And obviously you can adjust this based on your risk. Maybe you're a little less risk averse or more risk averse, and you do 25, 25, 25, 25. Maybe you do 25 times, right? Different ways you can cut it. It's whatever works for you. Depends on your confidence in the name. Depends on what you like it. Depends on your research. But for this name in particular, before I would do anything, unless I love it and I wanted some exposure before earnings specifically, which at the time would be right now where it's at this price. If I wanted that exposure, I would get in on small size. If I don't want that exposure, I think it's smarter to wait till after earnings. You may be late to the party, as you heard me say earlier in the stream, and be late to the party, but at least you're at the right house. And that's what matters. I took some cash secure puts on last earnings, was signed at 420, need a rebound. Okay, I mean, if you're signed on shares, aren't going anywhere, so that's good. But that was alluding to Microsoft, so I think you'll be fine long term. I don't think Microsoft's going anywhere. By posting the impact of tariffs, they've now entered politics. Dumb. Yeah, I don't disagree. You can say things without saying them, and then still have similar impact. So, yeah, it's better to stay quiet. Anyway, oh, that is weird. Thanks for showing me that, Toby. Let's get into, I guess, options operation now. Unless you guys want to pull up another name. Yeah, that would have been the short. You saw me snipe the top yesterday on live. I said today I wanted to wait for 553. We didn't get it. 553 or the gap fill at that 554.51. It's okay. This week, me personally, so in terms of trading, I am taking it super, super slow. Tomorrow is going to be very important. Today's very important. Actually, let's check the IV. I don't know what at the money IV is right now. I haven't looked. It's 35%, which normally is pretty high, but we've seen 150 in the last month. So it's low, but not normally, but it's low, question mark. IV percentile right now on the SPY, still 88%. So IV is still historically high, and its historical volatility is also high. So it is a tumultuous time to buy contracts on the S&P 500 or SPY in general. Yeah, so we'll just roll into options operation. Guys, if you're listening right now on X, Instagram, or YouTube, please do me a quick favor. Drop a follow or a subscription if you haven't already. I greatly appreciate it. Like the stream, share it out, drop a comment, etc. Thank you for being here, and thank you for watching along. We will now roll into options operation. So I've got two questions here from people in our community that I'm going to answer. And this is going to give you an idea of how options operations work if you haven't seen it before. And that way, if you want to participate next time, you can. So first question here says, I'm thinking about trading the Apple ER. Is there a smart way to do it? Good question. Let's pull up Apple and we'll take a peek. All right, so for Apple, that's earnings tomorrow, Thursday. So Apple reports earnings on Thursday. Currently trading at 211. You've got this gap to the upside here that would fill at 221.02. And obviously it's seen some downside in recent times as well. Kind of like in the middle of this range, I suppose. But looking to play earnings, I guess it would depend on which way you want to play earnings. but specifically asking if there's a smart way to do it. I kind of alluded to this when we were talking about Microsoft, so it kind of depends on your risk tolerance and which way you want to play things. Let's just look for kicks right now. 211. Okay, so right now, what's your IV on these? 62% IV. IV percentile is at 93%. So just so you guys understand, if you don't know what IV percentile is, that essentially tells you that 93% of the time, IV was lower on Apple. IV is implied volatility, so it takes everything across the whole chain to calculate your IV percentile and tells you how, if IV is higher or lower than it normally is in the last rolling 52 weeks. In this case, IV percentile, 93% of the time was lower. Makes sense because we have earnings, right? The other thing you want to look at is your HV. That's your historical volatility. So how volatile is the underlying name? So the stock. Apple's HV is pretty high. It's at 99%. This is the most volatile that Apple has been for quite some time. For the last rolling 52 weeks, Apple is the most volatile it has been essentially these last few weeks, which no shock there, right? So taking this information into account, we have to think logically on what's the best way, and obviously depending on your goals, how to handle this situation if you want to be involved with Apple. Looking at Apple, what I would look at is netting some sort of a credit exposure, meaning I am selling to open, or I'm net negative on an options trade. What does that mean? I will tell you. When you click that button and you buy a call or you buy a put, you are buying to open an option. In this case, I would heavily recommend you consider selling to open an option. Now this, depending on how you do it, would require a few different things, whether it's collateral. If you just directly sell a put, sell the call, you need to cover that position, because if there's one thing you take away from this program, ever, or anything, never, ever, 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 I don't care how good you are, I don't care how smart you are, I don't care how much money you have, don't sell naked options. And if you don't know what I'm talking about, then forget I said anything and don't even learn about it. Just don't sell naked options. I think it's the most ridiculous amount of risk anyone can take. I think it's foolish, and I think it's greedy. Never sell naked options. If you disagree, suck it. Moving on. So selling to open, or having some sort of negative credit position, I think would make the most sense here, because when you have a credit position, you essentially establish yourself in a way where the IV decay works in your favor. So you can establish, and the most conservative kind, or I guess I should say the easiest kind of thing you do, regardless if you're bull or bear, is to do a put credit spread or a call credit spread. That would establish a quasi sideways bullish or bearish take on the stock, but allowing you to short IV, which is important here because IV and IV percentile are high, and IV percentile is actually almost at the highest point. So that actually is just extra money. It's extra, I almost want to say like wind behind your back here, because even if the trade goes against you, IV can decay enough where you could still make a profit because you're collecting a high premium. So depending on how you view this name, whether you're bull or bear, I would heavily suggest you consider looking at a call credit or a put credit spread to establish a net negative or credit position on an options trade in general. Other things you could do, if you're more of a long-term bull or a bear, you could consider a calendar spread. Or let me rephrase that. If you're a short-term bear but a long-term bull, or vice versa, you could do a calendar spread where you could bet, but long-term you want to own the company. That can actually give you discounted shares long-term, or discounted options long-term, where you could sell a short-term option against a long-term option to get a discounted long-term option. That is also something you could do. If what I'm saying is going over your head completely right now, I'm going to give you the best, not advice, I could ever say, and just don't trade earnings. If you want to trade earnings, I think you need to understand trading them greater than, if I buy call money, stock go up, I make money. If I buy put, stock go down, I make money. That's a very archaic way of looking at options, and I think you'll find more times than not trading like that, unless you're lucky, you're more than likely going to get hurt a lot. So To answer your question about trading the Apple ER, that is the smart way to trade an Apple earnings or any earnings really, establishing some level of a spread where you're reducing your risk, you still get exposure, and you can still get a pretty good return. Even on like a credit spread, because premiums are inflated, you could still get a decent return for a low amount of risk. So that's how I would answer that question in particular. Let's pull up our next question here. X has taken 0 trades today. Oh, I'm glad we're on the same boat. Let's see. Second question. I currently have NVIDIA May monthly 120 calls that are underwater. How should I handle this? Okay. That's a good example of one that I can answer that's not giving specific financial advice, because I don't know enough about this trade to give this person specific financial advice, because I just know it's the May monthly 120 call. I have no idea of the dollar amount. I have no idea of their exposure. I don't know anything else. I just know they're red on the trade. So let's take a deeper look. Now this one's not very specific, but mostly pretty specific. May monthlies at 120. Currently trading about $1. Let's see. Okay, so earnings are going to be after that expiration. So unfortunately, you don't have the potential IV run-up with earnings in this case. So that works against you for recouping a loss here. Again, I don't know what your loss is. Your loss could be you opened it at $2. Your loss could be you opened at $29. I have no idea. But I'm going to safely assume... Let's assume this was opened in the last 2 months. So I'm assuming this person owns this contract north of 250. Just looking at the volume, unless you bought in on this dip here, but that would mean you're not red on it. And let's look. I'm just trying to make an educated guess here. I mean, you could even bought it 3 days ago. I don't know. And let's look at the Greeks. All right, so you have a delta 18, gamma 2. You gotta. All right, so your theta here is already bad. So your theta here is 8 cents. So assuming this contract's $1, it's $1.03. You're losing 10% overnight right now. So if you hold this into tomorrow, you're going to lose 10% of today's value to tomorrow. Excuse me. Sorry. Apparently when I don't drink water and I talk for like 2 hours, I just yawn. Anyway, Vega's pretty solid. 6 cents in Vega. It's hard to say. So when I do options trading, I like to do a conservative look, especially if I'm like day trading. And I'll conservatively take the delta and I will assume how much I can make as if there's no delta appreciation. So obviously as you move, or if you don't know this, maybe not say obviously, but if you don't know, as your contracts move closer to the money, your delta increases because there's a higher probability of that contract being worth something, because keep in mind, if it's out the money, it's worth nothing, and if it's in the money, it's worth something. Your delta is 1 essentially if it has value, right? So as you move closer to in the money, delta goes up. How I like to calculate my risk is assuming my delta stays pretty flat. So in this case, your delta 18, even if NVIDIA went up. Well, actually, here, let's use a real life example. 3 days ago, right? It hit a high of, we'll call it 112 for simplicity. Or 2 days ago, I'm sorry. Hit a high of 112 specifically. And as a result, these contracts hit a high of $2. That would mean a $2 appreciation from this price. If we add back in the theta, these would be $1.20. Hold on, I'm doing math in my head. 148. Okay, so that would assume that if we got back to that price today, these contracts would be around 148, 150. Again, assuming there was no delta appreciation. Now that goes both ways. As the stock drops, in this case because it's a call, that delta becomes lesser and lesser. So the way I like to look at things from a risk standpoint is, okay, I'm trading here at $1 a contract, right? If I think NVIDIA is going to go to where it was 3 days ago at whatever, again, 112 for simplicity, that's going to be a $2 appreciation from 109. I'm sorry, $3 appreciation from 109 to 112. So at a $3 appreciation, it'd be 18 times 3, it gets you 54. So that means if I'm trading at $1 right now, my contracts are worth $1.54. Assuming no delta appreciation. I take out the vega, I take out the gamma. I'm assuming delta just holds constant, right? So at that point, I have $1.54. So again, depending on where I'm sitting in my trade, if I bought at $4, if I bought at $2, that's going to change how I want to view this trade. I think the most important thing is to be honest with yourself in this scenario, because you are out the money $11 here, which is a little risky for a call that expires in 2 weeks, at least in my opinion, unless you are very bullish. Now, with that being said, you do have big tech ERs this week that could affect this name specifically, and it realistically could get back to like this 118-ish area, and depending on your average, that could put you profitable. But I think the smart thing to do would be to mitigate risk, especially in this environment, because you may have $1 right now, and whether that's a 80% loss for you or a 20% loss for you, because of the environment, you may want to consider de-risking and consider maybe taking a step back and cutting losers when they're losers. If you think it's a loser, that's on you. You're saying it's underwater. If you still believe in the trade, don't let me dissuade you. But I think the most important thing we can do for ourselves, especially as traders, is not lie to ourselves. If your trade thesis is intact, meaning everything you saw with this trade when you opened it is still valid, by all means hold that contract. But if your trade thesis was invalidated, you need to be honest and take the loss. Because when you have a 50% loss, you need a 100% gain to offset it. When you have a 70% loss, you need a 200% gain. When you have a 90% loss, you have a 300% gain to offset those losses. It's very easy to look at a 70% loss and make a 70% gain and think, oh, everything's better now. It's not. So as those losses get deeper and deeper, remember, you can only lose 100% of something, your ability to bounce back is lesser and lesser and lesser. And especially with options, things can change on a flip of a dime, in and against your favor. It goes both ways. But for this trade in particular, depending on where you're sitting, I would strongly suggest you consider evaluating your trade plan and seeing if your trade thesis is still valid. Now, I say this all the time as it pertains to trading. I will make a trade and I will hold a trade if my plan is in place, because I'm happy with buying whatever contract I bought, did the math, whatever. If my plan's in place, I hold the trade. The second the trade's invalidated is where you have to cut ties. You don't get married to trades, right? You don't get married to stocks. You have a set plan, you stick to the plan. There are very rare circumstances where I give things more rope. I give things more rope on equity trades. I actually did this for our community when we had the big drawdown a month ago. We have a program called Seed Decree where I gave a lot of rope to my positions. Now they're slowly coming back. Some I cut, some I kept. But I gave rope to certain positions where otherwise I would have taken a loss. I'm letting them slowly come back. Now that's on equity. Time is not really a factor. The factor is the price. Price goes up, price goes down. Options are so much more nuanced because they are a derivative. They get their value based on something else having value. So you cannot look at it in a bubble of, I think it's going to bounce back. Okay, it might bounce back, but how quickly something bounces back matters, because that time is so important with options. Because it's not a factor with equity, it is a factor with options. So if you're currently underwater in that May monthly 120 call, depending on your positioning, I would strongly suggest you consider the risk and consider your trade plan to see if it's still valid at this point in time. Alrighty. I think that's going to wrap up. Went a little bit long today, actually. 148 live viewers. Thank you all for showing up. I appreciate it. Before I sign off here, do me a quick favor if you haven't already, and if you have, I greatly appreciate you. Drop a like, drop a subscription, a follow, a comment, whatever. Appreciate you guys chatting over there on YouTube. Love talking with you guys while I'm live. And some say you need an edge to trade. Well, I like to look at things from a different angle. And that is, what you will always get here on the Atomcash Angle. Have a great rest of your day, and remember, precision beats prediction every damn time. Night, guys. Night. Good afternoon.